So our first presentation for today is the stochastic model underlying SAM's non-life underwriting risk module. And the authors of the paper are Ronald Richmond, Rowold van der Walt, and Pieter Foucher. I think Ronald's going to be doing the presentation, and he doesn't need a lot of introduction. We all know you very well, Ron, and have seen you present here before. So without further ado, let's get going.
So thank you very much to everyone for coming to this talk. Maybe I should remember how to speak before I start. And also thanks a lot to ASA for accepting this talk proposal. And this has been, I suppose we could have called this talk Fun with Sam, because that's really what it is. It's about how can we explore what is in SAM in a little bit more detail than you might have done to date. And can we sort of tease out what's the model that underlies SAM. The way we experience SAM often is a rush at the end of a quarter, quickly trying to get your QRT together. And I'm sure a lot of us know the formulae that approximate your 1 in 200 year loss across the various different components of SAM. At this point, probably people in this room know that off by heart. But where do these formulae come from? Can we formulate a full stochastic model around it? That's really what the topic of the talk is about. So I want to thank Pieter and Rowold, who are my co-authors here, for kindly working with me on this. This is a paper that we hope to release one of these days. It's more like a book, actually, and all of the information in here and more you'll be able to get, as well as some code. And really what we're trying to do is answer what is the stochastic model underlying SAM for non-life underwriting risk, and can we make it useful both for ORSA purposes, but also verifying and validating that the SAM standard formula is correct. Okay, so I'm going to move through some of the sections of this talk a little bit faster than others. I'm going to make the assumption that everyone in the room is relatively familiar with SAM. If along the way you've got a burning question, please feel free to ask it so it can be a bit more of a dialogue and less of a monologue. And let's go. So SAM, in terms of background, I think we all have been through this. If you've been around for a few years, we have a twin peak system in South Africa where you've got financial regulation separated into two buckets. You've got your prudential regulation looking at solvency and capital requirements sitting with the Prudential Authority and the SARB. It's really around the solvency of insurers, with SAM being the main tool that the PA has to ensure capital adequacy out there in the market. And then we've got the FSCA, which is focusing more on the customer treatment and TCF aspects. In terms of SAM, I think where it came from is it's an adaptation of Europe's Solvency II framework that was adapted probably in the years 2012 to 2018. The main person responsible for adapting non-life underwriting risk is in the audience. So if I say anything wrong, please correct me as well, because she knows it better than I do. And a couple of the goals in SAM were make sure that insurers can always meet their financial obligations with a very high level of certainty, keep the sector stable by maintaining the right level of capital. Probably the biggest change was aligning risk to capital. So in some of the previous capital regimes that we've had in South Africa, the riskier your business, that didn't necessarily translate into higher capital requirements. Whether it does in SAM is maybe also an interesting question, but the idea is to have risk-aligned capital and through that incentivize good risk management by reducing the amount of risk that you've got. You should therefore have lower capital requirements. There are 3 pillars in SAM. We've only got 2 operative. So there's capital adequacy, and we'll be focusing on the SCR component of capital adequacy. There's the systems of governance, focusing on the various different control functions you need to have and things like your own risk assessment. And theoretically in SAM, we should have pillar 3, which is market disclosure, which I'm told will arrive someday, but it hasn't yet. And the SAM balance sheet, also hopefully this is quite familiar, particularly because if you haven't done SAM and you're working in the corporate actuarial space, you will have done IFRS 17. You value your assets on an economic fair value approach. Your liabilities should be valued at a best estimate using something approximating a market consistent valuation. And your liabilities are composed of these 2 items: your best estimate liability, plus your risk margin, which is the cost of holding capital to support it. And then the capital that you have is assets minus liabilities. Sorry about that. And That's the SAM balance sheet in a nutshell. And the way to think of capital requirements whenever I'm introducing SAM to someone for the first time is think of all the assumptions that you need to have in order to put this economic balance sheet together, and what happens if some of those assumptions are wrong, whether it's assumptions around parameters, assumptions around forecasts of what's likely to happen. Imagine you have a big cat event and therefore your forecast of what's likely to happen is wrong, or imagine that you think your coefficient of variation of premium reserves is 0.08 and it turns out to be 0.12. What's going to happen then? That's what your capital's there for. That's what the whole point of the capital is to deal with those deviations from how you've constituted the SAM balance sheet. And that's just a nice way of linking your capital back to the core quantification of what a company looks like under SAM. So we'll be focusing on the solvency capital requirement because this is probably the more interesting part of SAM from a technical perspective. There's also the minimum capital requirement, or the MCR, which is basically a linear formula that's meant to be calibrated to the 85th percentile, if I remember correctly. The solvency capital requirement is the main regulatory capital target in SAM. It's the value at risk of your capital at a 1 in 200 year loss, or the 99.5th confidence level over 1 year. So in other words, looking at losses that could occur over the course of a year. How do you calculate it? You've got the standard formula, which is in the FSI standards. And the standard formula really consists of a bunch of formulaic approximations to this 1 in 200 year loss. So if you think about it, underlying that formulaic approximation to the 1 in 200 year loss should be some sort of model. And like good actuaries would hope it's a stochastic model. And the whole point of this talk is to tease out what can we say about a potential underlying stochastic model for what's represented in the formulae that you have in the FSIs. That's pretty much the topic of the talk. So introduction to this paper. So what are we going to try to do? We're going to try to develop an explicit stochastic model that reproduces exactly the same 1 in 200 year losses as the SAM standard formula for non-life underwriting risk. So we're not going to talk about life underwriting risk. We're not going to talk about market risk or op risk. We're focusing in only on non-life underwriting risk. And the way that we're going to do this is try to use the various different hints that we have in the FSIs. So for example, in the FSIs, you'll see it talks about insurer-specific parameters. Can we take the methodology given in the FSIs for each one of the components comprising the non-life underwriting risk module in SAM? Can we take what the FSI seems to hint to and build that up into an overall stochastic model for non-life underwriting risk? Once you've got a model, what's also fun to do is check if it's useful for anything. And what we'll try to do is verify that at least some of the empirical properties of this SAM stochastic model look sensible and potentially indicate that it could be used for things like Pillar 2, whether it's your ORSA or stress testing or cost of capital, any of those other good things that people build internal models for. We're going to draw an analogy to the development of the chain ladder algorithm. So I'm going to just delay talking about that to the next slide, but we'll show what some of the implications of moving from a best estimate in the chain ladder world to a stochastic model are, and we can then hopefully draw some parallels to what this means in the context of SAM. And hopefully at the end we'll have made transparent what is this 1 in 200 year value at risk that we're trying to approximate. So this is a running example. Imagine a fictional personal lines underwriter with 2 lines of business, more on the motor side and a little bit on the property side, so about a 3-to-1 split. We've simulated some experience since 2021, which is your year since COVID. And we've also simulated 3 different triangles. We've got costs, counts, and a severity triangle, which means that theoretically we can use the different premium risk methods and the different reserve risk methods. So for those of you who haven't done SAM before or haven't looked at the back of FSI 4.3, which is the standard that defines how you can derive your own set of parameters for premium and reserve risk, there is actually something there. I think it's attachment A or B or one of those attachments to FSI 4.3. And in that standard, it specifies these different methods for deriving your own set of parameters. I think historically a lot of people in the South African market haven't bothered to do this because the data requirements are almost as onerous as building an internal model. Recently I've heard that there's been some more interest in that. Anyway, this is what your SCR for this particular book looks like. premium and reserve risk is about a third of the size of catastrophe risk. We've assumed a 30% quota share across the entire portfolio. That gives you this risk mitigating impact, some impairments, and then you have a net non-life underwriting risk charge of about 146 million rand. If I've gone through kind of the basics pretty quickly, anyone want to ask any questions, or is it clear? Come on, guys. Okay, going to assume it's clear. So let's draw an analogy to the chain ladder. So the chain ladder, if you read some of the textbooks, apparently originated in the 1930s in an accounting department somewhere where they needed to project policyholder liabilities. And it was just a simple algorithm. Like we know, you take each cell of your cumulative triangle and you say, well, how did this cell evolve in the past? Assume that it's going to apply, that same sort of evolution is going to apply in the future, and you project forward. That's your chain ladder algorithm in a nutshell. In the late 80s and the early 90s, some people started thinking about, could you formulate a statistical model for the chain ladder? Probably the most famous paper in actuarial science, which is Mack's 1993 paper called A Distribution-Free Model for the Chain Ladder, was one of the ones where there is a set of point estimates for your first and second moments of the stochastic distribution of the chain ladder given. That's how I'd summarize Mack in a nutshell. Saying it in slightly less technical terms, you can get a statement of how much risk is contained in your chain ladder. So in other words, if you want to form a risk margin around the chain ladder's estimates, you can apply Mack's formula to derive the mean square error of prediction of the chain ladder, and pretty much from there work out what could your 75th percentile or your 95th percentile be. So this was a little bit before bootstrapping. Bootstrapping became a lot more popular than these closed forms approximations that Mack kicked off. But the same method that Mack has proposed in this paper, we now also can do from a bootstrap perspective, which is the Mack bootstrap. So that's the history of the Mack method in 30 seconds or less. A different approach, which some people took, was the over-dispersed Poisson method. So this was trying to say or think about how can we incorporate the chain ladder algorithm into a generalized linear model, or a GLM. And the way that you do that is actually very beautiful. You provide accident year effects where you have a different parameter for each one of your accident years. You have development year effects where you have a different parameter for each one of your development years. You fit that on the assumption that your response is distributed like a Poisson random variable, and suddenly you've got a GLM. And for everyone who's done statistical model in the audience, you'll know that once you've got a GLM, you can very easily work out what is the variance of the parameters, and from there approximate again what is the overall statistical model and distribution of the error contained in your model. So interestingly, even though these are both very different models, they lead exactly to the same best estimate. So they 100% reproduce exactly what you'll do if you sit there in your Excel spreadsheets, calculate your loss development factors and project forward. So each one of these models produces that, but they actually produce very different estimates of uncertainty. So what you can learn from this, using a very actuarial example, is even if your stochastic model for a particular process exactly comes to the same answer in terms of a best estimate, nonetheless it might result in a very different view on risk and capital. So this is a little picture where we took a triangle and we bootstrapped this triangle. I think it's a property line of business. And you get a Mack bootstrap. So as we said, the Mack's method, you no longer need to just calculate a single number. You can now bootstrap. And if you bootstrap this particular triangle, you get an estimate of risk that looks like this. There's a coefficient of variation for your overall triangle of 0.287, and your 1 in 200 year risk is 15.2 million. But if you apply the ODP, while you should get a very similar mean number, only 50,000 Rand off, you can see that you've got a vastly different coefficient of variation of 0.4. So this doesn't actually look like a property line. This looks like some sort of heavy commercial line of business. So you can just see what the impact of a stochastic model and the choice of the model that you make gives, even though what we've represented as your best estimate, which is a red line, is almost exactly the same. So hopefully that will help to prompt our thinking a little bit, that as we formulate stochastic models, there can be a multitude of different modules that can comply or can make sense in the context of SAM. And yeah, so it's quite a difficult problem to solve. Anybody want to venture a guess what's a better model, the one on the MAC or the ODP? I've been asking this question for a long time and no one ever gives me an answer. Why? Sometimes imposing distributional assumptions is good. Sounds like it's 50-50. No, but I mean, you're right. Almost everyone in the market will choose MAC. But it's very interesting that there's another very well-known stochastic model which does things in a slightly different way. But I would probably pick MAC. Definitely make your CFO happier if you do that. But it doesn't necessarily mean it's right, I guess. Okay, so what are our contributions going to be? We're going to run through some of the requirements in FSR 4, which is your overall regulatory document dealing with the SCR. We're going to run through FSR 4.3, pull some things out of there, which is the document dealing with non-life underwriting risk. We'll talk about some of the logic from DD 78, which is the original design document that was put together by the working group for the old FSB, and you can still download off the FSCA's website. We're going to try to propose minimal joint one-year models for premium and reserve risk, catastrophe risk, and counterparty default risk. And eventually, when we make the code public, you'll be able to run this and come up with your own little internal model variant based exactly on what Sam says. So what are some of the desirable characteristics for reproducing Sam, given what we've been discussing? Ideally, you should match the 1 in 200 year loss as closely as possible. So in other words, we want, if you think about what the chain ladder models give you, they give you a best estimate. Here, we don't have a best estimate. We want to match the 1 in 200 basically as closely as possible. We want to reproduce the aggregation dynamics provided by Sam, and it's going to turn out that this is going to be very messy. You can't reproduce the aggregation dynamics. Just for clarity, what we mean by that, you know, all the square root of sum of squares formulae to allow for diversification and correlation. We'll look at that in some detail. Ideally, it should have reasonable behavior at the lower quantiles of your overall loss distribution, which means that it's something you can somehow relate what the model says is going to happen in a 1 in 2 year or 1 in 3 year event to the reality that you're familiar with in your business, and it should be based on relatively reasonable inferences from the FSRs. And as we go through, if you feel that we're not meeting these desirable characteristics, please shout and let's see what you think. So, I think we've said most of this already. The goal is to have a unified stochastic model that integrates all components and reproduces your final SCR for non-life underwriting risk. And we're going to use the aggregation structure. So there's always different layers of aggregation and correlation in SAM. The highest level here is the aggregation between your different risk components, which are premium and reserve risk, lapse risk, and cat risk. Underneath there, you are going to have potentially more correlation matrices, let's see, in your various different models. And then there may also be some other assumptions needed for these items, for example, your risk mitigation impact of a stop loss and other things like that, that we're not going to delve into in too much detail. The other thing that we're not going to go into in too much detail is lapse risk. Lapse risk is a total non-starter and waste of paper for 95% of the insurers in the South African market. In my various time being half, I've only ever seen one insurer where it made sense. Has anyone ever calculated a lapse component not equal to 0? I shouldn't have guided everyone so much. So I'm going to assume everyone agrees with me. If I've got it wrong, please tell me. And then impairment's going to be an overlay. As you know, we have to do impairments within each component of the non-life underwriting risk module. So just talking about what do the regulations actually require, like we've said, you need to calibrate your capital requirement to your 1 in 200 year loss event. The main ideas are articulated in a little bit more detail than you have in the FSRs in DD 78. If you read DD 78, you'll find this interesting paragraph, like I did a few days ago, that basically has got 8 or 9 critical enhancements to non-life underwriting risk, which no one ever did. So it's always fun looking at what we planned on doing and doing an actual versus expected, but the actual is 0 in this case. This is how we aggregate in SAM. So this is the prescribed correlation matrix for non-life underwriting risk. And you can see that the only major correlation that we've got is between premium and reserve risk. and catastrophe risk. And whether or not that's reasonable is potentially something to think about. Generally, the big once-off shock events that we've had in the South African market recently, like the KZN floods or COVID, haven't had a huge impact on reserves for closed accident years. At the point in time when those shocks happen, you don't have any reserves against them in terms of IBNR or OCR. It's only prospective reserves. So whether or not that 0.25 reflects the empirical reality or it's been set more out of some sort of conservative perspective by taking it up from 0, I think is something to think about. And then the final formula is that rather large equation on the bottom, but basically, if you just focus on this piece, it's the square root of sum of squares of your various different contributors to capital, as well as the covariance terms between them. And that's hopefully something that we're all familiar with. And as we've said, you have sum of squares all the way down in SAM. So not only are we going to do this at the module level, you're also going to do this on the component levels. For example, I think you do this between premium risk and reserve risk for each line of business in your premium and reserve risk component. If I'm not mistaken, you do this for several of the man-made catastrophe perils, like for trade credit. And then you also do it in a bunch of other places. So this sum of squares, basically it sums of squares all the way down. And what is the underlying probabilistic model, to ask the main question that we're trying to address here? What is the underlying probabilistic model that makes this mechanical aggregation correct? And we'll have some examples of elliptical distributions on the next slide, but it's mathematically exact if and only if your joint risk vector X, imagine X contains all of your outcomes from premium and reserve risk and cat risk, only if that follows an elliptical distribution. So an elliptical distribution is something like a multivariate normal or a multivariate T or some other more exotic ones where your density contours of equal probability form ellipsoids. So if you've forgotten high school math, I couldn't remember what an ellipsis was yesterday or the day before. Here are some really nice pictures. And what we have over here, this is simulating from a bivariate Gaussian distribution or a multivariate normal. These are the little bits and pieces of the simulations. We have a student T distribution where the tails are a little bit heavier over here. And here is a simulation from a Clayton copula. For those people who've done copulas in your actuarial training, it's just a way of relating two distributions. But what you'll see is that your normal distribution, if you plot, for example, the probability level that only occurs 5% of the time, you'll see that forms an ellipsis. So too with the student T distribution. Even though you can try plot it there, you can see it's a mess. It's much more linear than ellipsis would be. So if you've got anything more exotic than an elliptical distribution for your correlation structure, SAM immediately breaks down. So let's see what that's going to tell us. We could choose potentially to simulate, like we said, from a multivariate normal. The 99.5th percentile of a multivariate normal is 2.57. But the first hint that we get that maybe that's not what the FSRs are doing is you can find this approximation of 3 instead of 2.576. You can find that approximation of 3 in a few places in FSR 4.3. One place that you find it is in premium and reserve risk. Once you've aggregated up your risk parameter, which is called sigma, across all of your lines of business, you multiply that by 3. The other place you can find it is in market risk under type 1 for reinsurance counterparty default risk, where in the formula you have 3 times the root of V. We're going to get there if those formulae are making your head spin. Basically, the point is that it seems to be that SAM assumes something where it's a heavier tail. So you could look at it maybe as a 16.5% loading over and above what a normal distribution would do. Another problem with the normal distribution, besides the fact that it doesn't seem to be indicated that that's what we're doing here from the 3, is that you've got tail independence. So you've got independence between different types of insurance risk, which is probably not the right model for very extreme events in capital. I think the FSIs do say somewhere, maybe someone can remember the reference, that 3 is an approximation to normal, but given that it's 3, hopefully there's something more than just saying it's approximate. And what we can do, if we rather assume a multivariate student T distribution, and really all that does, think of a normal distribution but with heavier tails. What that means is it's a distribution where the probability of having a very large event, like a 5 sigma event as measured by a normal, is in fact much more likely. It might be a 2.5 sigma event in a in a student T distribution. And we control the heaviness of those tails by a parameter called V, which is your degrees of freedom. And interestingly, you can find a V, or a degrees of freedom parameter, which exactly reproduces Sam's number 3 over here. And that is a T distribution with almost 6.5 degrees of freedom. So one way of looking at what SAM does when it's using these distributions and it's thinking about the core distributions underlying the premium and reserve risk component is, one way of thinking about it, it's sort of a fudged Gaussian or a fudged multivariate normal. Or you can be a little bit more precise and say what they were thinking of is really a student T with a relatively heavier tail that allows for more extreme events. So how can we now simulate non-life underwriting risk with this knowledge that we've now got in our heads? So we've got two main insurance risk losses, which we have from premium and reserve risk and from catastrophe risk. And these are built bottom up in SAM. So what you need to do is you need to look through your portfolio of insurance business. You need to work out what lines of business you have, what are your premium volumes, and all of that sort of good stuff. So too with catastrophe risk, you have to look at various different distributions of catastrophe risk across your geographies. So you do that bottom up and you come up with a number. So if we want a stochastic model that allows us to simulate from these things that have been built bottom up, how can we do that? And what we're going to discuss here are probably two methods. We've come up with a very simple method that just applies a little bit of linear algebra to allow you to simulate from this. And then we're going to talk about the Iman-Carneva approach, which is something I wasn't taught. I think it's used in some of the capital modeling tools out there, and we'll look at some quick examples. So what the main idea here is, remember in a normal distribution, if you don't have any mean of your normal distribution, then the way that you simulate is you take a standard deviation parameter and you just have many different draws from what that distribution looks like. So in this case, let's say we've got a multivariate student T distribution. We're going to draw three different random variables from that distribution. And if you want to then simulate for a particular standard deviation, what you can do is you get your standard deviation, multiply it through, add it up, and that's your answer. So that's a very simple recipe that is very useful for simulating from distributions. So what you could do is you could take each component of your non-life underwriting risk, divide it by a quantile of that distribution to give you an implied standard deviation parameter, and then simulate over here using exactly that formula. So we call this EES, or elliptical exact surrogate. And the very nice thing about this is it exactly reproduces the correlation and aggregation assumptions that we have in SAM. So the problem is EES isn't so easy. So what we did over here is we did a whole bunch of simulations using exactly the method we had before. We have what I'm showing over here is, in red, you have your premium and reserve risk distribution implied by this method. In blue, you have your catastrophe risk. Like we saw before, you've got a much higher capital requirement for catastrophe risk compared to premium and reserve risk, which is exactly what you'd expect if you've played around with SAM for a bit. But the problem is these losses are symmetrical around zero. So what that means is, let's say you have an exceptionally good cat year. What are you going to see in your P&L? You're going to see zero. You're not going to see that you actually start making money from catastrophe risk or the lack thereof. It makes a little bit more sense to allow for some element of profit through premium and reserve risk where you're actually charging premiums against it. So I would say is that you find as soon as you start trying to build a stochastic model for SAM, the quite shocking thing that the basic assumptions in non-life underwriting risk don't make sense in the context of cat risk. So that's your first breakdown where if we wanted to be entirely honest and say, can you build a stochastic model that reproduces SAM? The answer is no, because SAM is mathematically incoherent because of exactly this problem. So what you could try to do, potentially, is you could potentially try shift this distribution out and maybe only get it starting at zero. And you can do a little bit more math to show that if you do that, it's no longer elliptical. So that's just providing a little bit more context for my statement that if you do go on this journey of trying to build a stochastic model for SAM, things fall apart pretty much at the top of the house. A different way of doing this is parameterizing copulas. So a copula is a beautiful statistical construction that decouples each distribution. So for example, your premium and reserve risk distribution from your catastrophe distribution, and you can fit whatever distribution you want there. You can fit log normal, which has got the very nice property that it's only ever bigger than 0. And then you can come up with a flexible dependency structure. And we go into this in quite a lot of detail in the paper, all of these different things. The problem is you never reproduce SAM. The other problem is you also have to fit a copula, which can be a little bit hand-wavy sometimes. So what we would prefer to tell you about is the Iman-Conover approach. So this is a really flexible approach, and I'll just explain the algorithm to you. Hopefully it will make sense. Imagine you've simulated from your underlying risk distribution. Maybe it's premium risk or catastrophe risk, and you've now got 1,000 simulations. Imagine what you also do is you take a distribution which encapsulates or covers the sort of correlation that you'd like to induce between different simulations. So the way that you could do that is imagine simulating from a multivariate normal distribution. And what you do is you rank each one of those outputs from your multivariate distribution. You rank each one of the columns of each component that you have from your marginal distributions. And after you sort them according to the rank that you get from your correlated distribution, it turns out that you induce correlation into this overall set of simulations. So what do you start with? You start with 2 or 3 completely uncorrelated distributions, like you could simulate from premium risk, you can simulate from reserve risk and cat risk. You simulate a central driver of correlation, and by matching the ranks between what those drivers are and your observations, you'll end up inducing correlation among within the simulation. It's very interesting. It feels very non-actuarial, but some of the capital modeling software out there actually uses this approach. And what happens when you do it, let's say that we decided to model catastrophe risk using a Gaussian where you take the absolute. So imagine that's your normal shape of your bell shape of your Gaussian. You're going to take the absolute value, so it's only positive. Then you get something that looks like this. And this now suddenly looks a lot more reasonable. Premium and reserve risk we keep the same. Catastrophe risk only starts out with positive losses. You don't exactly reproduce your non-life underwriting risk though. So that's the problem. So this is a way of coming up with an overall set of loss distributions that make a lot more sense. In fact, if you look at this distribution over here, which is the total non-life underwriting risk distribution, this makes a whole lot of sense. It looks similar to the output I've worked with from internal models over the years, but the big problem is it no longer ties back to SAM. So that is almost the top of the house. Let's see if there's any questions there, but just in summary, what I've done is looked at that first aggregation formula that you have in non-life underwriting risk, said, can we find a stochastic model that reproduces it? And the answer is no. Should I stop there and we go get coffee, or do we carry on? Any questions, guys?
So this one's just slightly higher, and do you think it's because we shifted the cat right now?
We've shifted the cat, and you no longer have the assumption of independence in the tails. So your tail risk scenarios will be much more highly correlated. So it makes sense that you've actually got a little bit of a heavier tail over there, which is exactly where your capital is coming from. So what I should have done, John, if I'd anticipated your question, was look at expected shortfall, and then we could verify exactly whether or not it's a heavier tail. But I think that's what's going on. Okay, let's look at premium risk stochastic model. So there's a talk by David Kirk a little bit later, which is going to go into a little bit more detail here. So I've kept this section a little bit light. What is premium risk all about? Basically, what we're trying to do is capture the potential deviations from your business plan combined ratios. So what you'll do is talk to management, get very optimistic numbers, talk to your actuaries, get much less optimistic numbers. If it's not a very actuarial company, you'll be forced to use the optimistic numbers. is generally the way it goes. And then the reason you hold premium risk capital is in case you don't meet that level of optimism. So that's not entirely technically correct what I said, even though it is empirically correct what happens out there in companies. And the reason it's not entirely correct is you're meant to have a best estimate set of business plan loss ratios. If you deviate and you use something optimistic, then this whole capital requirement falls apart because you're not allowing for bias in your capital modeling usually. So, but the idea is that if you do have a best estimate set of assumptions, what could happen is that you may not meet those and you need capital to float the ship if things go wrong. A very interesting and significant assumption here, which I'm not sure how widely known this is that you don't allow for the offset of the profit you expect to make in your SCL calculation of premium risk. So no one's generally budgeting for 100% combined ratio. You're generally budgeting somewhere between 90 and 100. If it's much lower than that, your competition will make sure that it's not going to stay so low generally. But what the point is that let's say you've got 10% profit embedded in your business plan, that should offset some of your capital. And even if you have an internal model explicitly in FSI 5, which is the prudential standard for internal modeling, says you have to make a special application to the PA to allow for recognition of that expected future profit. So this is a very conservative assumption that's baked into premium risk. And then the way that you'll see that we'll go through this is we will allow for distributions that capture some of that profit. So the premium risk mechanics, it's very difficult to come up with a stochastic model here. It's very hard to understand, for example, why what you earned last year, if it's fully earned, is going to affect your risk this year. Looks like it's just conservatism, so I didn't bother trying to model that. But what we did try to model is the underlying components of premium and reserve risk itself. And the way that you combine premium and reserve risk, just before we get into the details, is you work out a risk parameter both for premium risk and for reserve risk. You combine them using another correlation parameter. So there's, as we said, square root of sum of squares all the way down. And then you aggregate into an overall number by summing across your various different lines of business. And what's very nice here is that there's, in a way, 3 different windows into the underlying model in SAM here. And the way where this is, as we mentioned before, is that if you look in the ISPs, which is the insurer-specific parameter documentation at the back of FSR 4.3, you'll see that there's 3 methods. Whoops, I'm sorry. Okay, I broke that. I hope it's in someone's premium risk calculation that they need to replace. Ignore this, and we'll just work through the 3. So the 3 models go through a really shocking evolution in terms of complexity. The first model is basically just a loss ratio volatility process. So here is your best estimate loss ratio on the left part of that equation. And on the right-hand side, you've got your volume measure, a risk parameter, and another distribution, which is generally assumed to be a normal distribution. And so really what this is just saying that every year you have the same baseline loss ratio. And the reason that we see differences coming out if you look at your ultimate loss ratios in a triangle is just random variation. Nothing's really changing over time, which is a very weak assumption. Something very interesting about this particular model is that as you increase the exposure, your coefficient of variation, so in other words, a measure of the amount of risk to the amount of exposure decreases. And what that says is the bigger your portfolio, the less risk that you have of this random variation. And again, whether or not that's true entirely is probably a little bit questionable. The second one is effectively exactly the same thing as we said before, except instead of using a normal distribution, it uses a log normal distribution. So think of a much heavier and fatter tail. And in this case, there's an acknowledgement that aggregate losses can be skewed to the right. In other words, there's a limited amount of profit you make on an insurance book, but you exposed at least on gross and before applying limits to maybe even infinite risk. And what happens with this log normal model, just in terms of the rationale, is that your coefficient of variation stays constant with exposures. The last one is where things get completely out of hand in the FSIs. This is a structural collective risk model. And when you look at this, you may remember this is just your collective risk process that you learned about in varsity, what happens is that someone thought it was important to incorporate parameter uncertainty via random effects. So you've got a bunch of very difficult to implement formulae. I don't know, has anyone ever implemented this successfully? Okay, I'm going to take that as a no. But something that we were thinking about as we wrote this paper is forget about these random effects. Assume that there are no random effects. In other words, we're not trying to model parameter uncertainty explicitly, and a much more parsimonious model that fills in the missing middle between your log normal model and the structural risk model is just a very simple collective risk process where you simulate from a Poisson to get the number of claims, you simulate from any severity distribution to get what each claim costs, add it all up, and that's your capital number. So just as we're looking at this is something that's always bothered me. Why do we never have a link back to the way that we normally simulate in SAM or in capital modeling? And the truth is that we do have it. It's just been horribly disguised in ISP method 3. So I'm expressing a lot of opinion about a very technical point. What can you do? That's where life takes you, I guess. Okay, so that's premium risk. Reserve risk is very interesting. Basically, the shift from the way that we had always bootstrapped to SAM is the idea of having a one-year risk view. Is anyone not familiar with one-year risk? Whatever I say, it's just yes, so maybe I should actually spend a bit more time here. What happens in this one-year reserve risk is you're trying to look at the risk not of where's your triangle ultimately going to land up, but what is the risk that your payments that you expect to make on the next diagonal is wrong, and that when you re-reserve the triangle next year, you have to increase your reserves. So that's a very basic definition of your one-year reserve risk. This is based on a paper by Mario Wuttrich and Michael Mertz that was published in 2008 and has basically become the standard for reserve risk capital modeling. I'm not going to go through all the notation. The basic idea is that if you get your reserving 100% right, then whatever happens, you should have already taken it into account last year. So in that case, your claims development result, which is what is being measured in Solvency II or SAM, turns out to be 0. And there's some really nice methods which are given in the ISP method 2 in the FSIs for calculating this. The one interesting point, just as I'm moving through this, that I'd like to make is your mean square error of prediction for this reserve risk contains two things. It contains process risk, which is just the random variability about your best estimates in each cell of the triangle. And it also contains parameter uncertainty risk, because you never know what the true parameters of your reserving model are. And that's actually quite different from the rest of SAM. If you look at life underwriting risk, it's just a cat event has happened, or the trend changes. Or if you look at non-life underwriting risk, in the rest of non-life underwriting risk, it's a cat event happens. You never talk about parameter error. A place you definitely never talk about parameter error in the rest of SAM is in market risk. You assume that you've got full visibility of all of the relevant parameters in the market and that you base your stresses on that. So if you're trying to build a stochastic model for capital, something you should always ask is, should you include parameter risk? The answer generally is no. Because then your capital requirements are too big. But here we do include it for some strange reason. Because this is a little bit more well-known and people have been through IFRS 17, I'm just going to give a very quick example. This is what one-year reserve risk looks like on MAC, and this is on ODP. And you can see that basically at the 1 in 100 year point, your 1 in 200 year risk here on a one-year basis is just a little bit less, 7% lower than your ultimate. And unless you're writing some very long-tail business in the South African market, this doesn't really make much of a distinction. If you want to be super correct, you can allow for it. I don't think I've seen anyone in IFRS 17 who has allowed for it. And the last piece that we've been waiting for, or almost the last piece, is catastrophe risk. How can we model catastrophe risk? So in premium and reserve risk, we've got all of these beautiful statistical methods. We've got all of these parameters. All that we get for catastrophe risk in the FSIs is a tail quantile. So for example, for earthquake risk, you get a factor of 0.34% of your aggregated exposure, and that's meant to give you your 1 in 200 year earthquake shock. So what can we actually do if we want to back solve a model that meets SAM? If you think of all of those desirable characteristics that we had at the beginning of this talk, what can we do to back solve something in the catastrophe risk space? So as we've said, there's a whole lot of models which can give you a 1 in 200 year number equal to any particular number. You just need to choose the parameters correctly. What we try to back solve is the following sort of decomposition. Imagine that each one of your catastrophe risk scenarios is composed of 3 things. Q is that number that the regulation gives you, the 0.34%, which is, as we've said, a black box. Very hard to work out if that's calibrated well or not. The reason that you can't use a proprietary catastrophe model to see if that 0.34 is right is a lot of the catastrophe model vendors try to calibrate the 1 in 200 to SAM. So it's completely circular now. So whether or not we'll ever get a proper number, there's a different story. E in that equation is your exposure. And then imagine that Y, this over here, is a single dimensionless positive random factor where at the 1 in 200 year level gives you a 1. So what does that mean? At things under the 1 in 200 year level, you're going to get 0.2, maybe you'll get 0. But once you are at a 1 in 200 year shock, the 99.5th quantile of that distribution is going to be equal to 1. So what's going to happen to this formula over here? It's going to fall out exactly as what you have in SAM. For everything else, you can now simulate. So to the extent that you trust the SAM risk parameter, which you kind of have to do because everyone's now anchoring to it, the only modeling choice you need to make is now in Y, which is what are we going to model? And just a couple of interesting ideas. I'm not going to spend too much time discussing this. Just like we said, if you have a normal distribution, you can take the absolute value and only take 1/2. Imagine you do that with a t distribution. So it's going to be a little bit heavier tailed, and you can control the tail heaviness, maybe 4, which is very heavy tailed for earthquake risk, and 8 for hail. A different way that you could do this is a log normal, which calibrates to your 1 in 200, and the free parameter you can calibrate to your horizontal scenarios, for example. That works really nicely. And then the last one is to create a frequency severity approach, where you work out what is your expected number of catastrophe events in South Africa. Again, some vendor models will tell you you have 2 major earthquakes a year in South Africa, so don't look at that model because that's not empirically correct. But probably for earthquake risk, you can set your frequency parameter somewhere to 0.05 or 0.1 for a catastrophic earthquake, and then you can just fit a generalized Pareto distribution. So again, within the paper, we show how you can calibrate this to your own view of catastrophe risk, and that turns out to be quite nice and useful. Last one is counterparty default risk. This is where this paper started with Peter many years ago, where we were discussing, can you build a simulation model for counterparty default risk? And there are these really horrible formulae where if you look at them in the FSRs, it's completely opaque where they came from. Where it came from is this interesting paper from 2008 by a fellow called Terberg. I think that's how you say it. And what happens in this paper is it's just a 1-factor stochastic credit risk model. So in other words, you have a baseline level of credit risk, and then you assume things go bad in the economy. It could be the global financial crisis. It could be a huge cat event like an earthquake in San Francisco, and all of your reinsurers start defaulting. Think of it like that. And then once you work through that model, there's some very nice math in there, and you come up with this formula, which is what we use in the FSRs. And I've purposefully gone a little bit fast over here, just so that we can look at some results and draw some conclusions while allowing for a little bit of discussion. So let's just talk about all the choices we're going to make, summarizing what we've discussed over here. So we're going to use a student T driver. We are going to use the Inman-Conover rank reordering, which hopefully everyone remembers. We're going to simulate using Gaussians for premium and reserve risk. And if you think of the shape of a Gaussian, it's symmetrical, so you've got both profit and loss. So we will allow the company to make some money. We've ignored lapse risk. We've assumed a 30% quota share with 2 reinsurers. We've adopted the method 1 that we propose for simulating cat risk, which is a folded T distribution. And that's pretty much it. Let's see what it looks like. So this is on the top right-hand part of the slide, you've got a distribution of total losses. You'll see that that point over there is 0. So we allow in some of the situations for the company to make some money. Remember, there is some reinsurance over here, but we haven't assumed reinsurance commission. So probably this should be a little bit more profitable. We haven't assumed investment income, so it should be even more profitable than that. But this, so just trying to justify why we only see a small slice of underwriting profitability in this particular scenario. On the bottom right-hand part of the slide, we've got the individual risk distributions. Red, you'll see stretches from negative, which is profit, to positive, which is loss. But everything else starts at 0. And we've got both a stochastic simulation of catastrophe risk and a stochastic simulation of default risk built in there. And if we just look through, your median scenario is for this particular company, you lose 21 million rand purely on your underwriting results. And your 1 in 200 year capital is 140 million, which is not all that different from SAM. Maybe we could quibble over here and say we haven't subtracted out our best estimate, but it's still close enough, in my view. So I think what you can see, if you look at this picture that we've got, is that by applying the stochastic models we've tried to fit to and reverse engineer out of SAM, you can actually get something that looks relatively reasonable from an internal modeling perspective. And hopefully what that will serve as is a little bit of encouragement for the South African industry. Traditionally, we've been much more hesitant to build capital models than our colleagues in the United Kingdom or Australia or Canada. And what hopefully you see from this is by making a couple of relatively basic statistical assumptions, you can come up with an internal model that's justifiable based on the regulation. You don't need to do too much parameterization work, but still could be useful for things like ORSA or capital planning or stress testing or anything else that you might want to use it for. So let's just run through our main findings. Premium risk is nice because you've got the biggest hints as to what's going on. We've given and discussed 3 distinct stochastic models. Reserve risk is an adaptation of max mean square error formula. Catastrophe risk, we need to treat a little bit differently because there's really not much hints given in the FSIs. It's basically a 1 in 200 year parameter that we have to build models on top of. And then default risk, if you delve a little bit deeper than the FSIs, you see is as simple as a single factor credit risk model. A little bit of the implicit assumptions. We've spoken about the fact that in SAM, your premium risk formula assumes a 100% combined ratio. And to get out of that, even in an internal model world, you need special permission from the Prudential Authority. Something that's obviously wrong with all of the models is that everything's stationary. We're assuming that the world doesn't change. Where that manifests is in premium risk. You assume your loss ratios are just things that you can't quite get a handle on because of too much volatility, but they're fixed over time. We know that there should be trend risk. We assume your reserve risk is unbiased. So in other words, whoever set your reserves has set them exactly at a best estimate, and it's always a little bit puzzling why we don't spend more time verifying best estimates in South African actuarial practice because the whole of SAM is predicated on that. And we also assume that CAT experience is stable, which, as we've seen in the last 5 or 10 years, is probably not the greatest assumption. We have assumed risk separation, that your really extreme events happen in CAT risk, not in premium and reserve risk. And as we said, probably the most strange and bizarre thing that's happened as we started building this is this realization that, in fact, that you cannot build an exactly faithful stochastic model for aggregation risk in SAM if you've got any component that's positive only. So right at the top of the house, the non-life underwriting risk formula falls apart. And with that, hopefully this was interesting. I think we've got maybe 5 minutes for questions.
This is a room of QRT experts. I'm sure more than thousands of QRTs have been completed collectively here, so I'm sure there must be a question or two.
Thank you, Ron, always for a fantastic presentation. Say for a company that has done, tried to see how their premium and reserve risk compares to SAM and it's come out higher. Any ideas on how to handle that and tackle it in the business and potentially with the PA if they're to share those results?
Probably you should put that in your ORSA and work out, do you need to hold any extra capital in your margin over the SCR as a result if it's coming out higher? Using these sorts of techniques, what's quite nice is you can compare your loss distribution from premium risk and reserve risk to what SAM's implicit distribution is. So maybe you'll understand that there's a lot more tail risk, or maybe you'll understand that it's actually just a shift outwards of the parameters. So I think applying these sorts of ideas and looking at different percentiles can also help you pin down what exactly is it. Is it a distributional assumption? Is it a parameter assumption, etc.? And then even if it does come out a bit higher, remember you've also got the 100% combined ratio assumption, which as long as you're profitable will save the day from an author perspective.
Perfect. Mine's just more of a clarification. I don't know if I was following at the end. So the 1 in 2, your best estimate, that not being 0, I don't know if I was entirely following why.
Yeah, your mean, that's basically what you expect to happen. It's the median of the distribution.
And in this case, I know you mentioned RR-Com and the combined
So
ratios.
here, I think the fact that it's 21 million, a loss in your best estimate case, probably flows from the fact that we've ceded 30% of premiums and losses, but normally what happens when you do that is you do get some profit back from your reinsurer. So that would knock that 21 million, I don't know, down to 15 or 5 million or something like that. What was the other piece that I said? Oh, you haven't allowed for the release of profit in your premiums. So we don't have premium provisions in here, which you don't need permission from the PA to release profit from. And if you got permission from the PA, you could release profits from future business. So probably this parameterization from a pure SAM perspective actually makes sense. That it's giving you something where you're making a loss in your median outcome. Do you agree still?
Yeah, I'll have to think about it.
Okay.
But thank you.
Thanks very much, Ron. That was a really interesting presentation. My question is on the cat risk. I think that's a very big driver of the SCR, and it's a bit unfortunate that it's almost like, and then some magic happens and we get to this number. Do we have any insight into how it was calibrated for SAM? And otherwise, if we were going to do a better job to calibrate it, how would we do that?
The urban legend that I've heard is that some people did run some models on exposure data from the industry. I don't know if anyone in the audience would like to confirm or deny that. But I heard that some cat models were run. But I think what's happened subsequent to that is a lot of the model vendors that I've dealt with have now tried to force fit their 1 in 200 back to the SAM number. So it's completely circular now. What you really need to do is probably look at the model outputs before any kind of fine-tuning is done to make it match the 1 in 200. And if you can do that, that would be the right way of doing things. There are some really, really good models out there also today that weren't available back then. I always like to use the Gallagher Hail model. They're not paying me to say that. But it's a really good Hail model. And it's that sort of thing where if you can also check that they haven't fiddled with it too much to make it look commensurate with SAM, that you can break that circularity.
Cool, thanks very much.
Ron, thank you very much for that presentation. Please give Ronald a round of applause.
Are we done?